Okay, this is the second part of the video about uh, uh, our tax equity. Now, the reason I opened it to that page is in my last video, I went through very little bit of discussion about corporate PPAs and the associated merchant risk for not hitting the exact targets, the settlement, and things like that. I have a secret little weapon, and I got some corporate PPAs, and I have to disguise them a bit and show you how the settlement works. That's going to be in a future video. But in this video, it's the second part, and in this second part, I run out a little space here. I'm going to address for the debt sizing. How about for project debt at, we can call it the LLC or the SPV or whatever we want to call it. And we'll work through just a little bit of how we set up the sources and uses once we have the debt size at the project level. And then we'll talk a little bit about project debt and why tax equity investors might not accept project debt, and just a little bit about the pros and the cons of project debt. And then we'll make a balance sheet at the LLC, at the partnership, at the SPV, whatever we're calling this. And the only trick really to get the balance sheet to balance is this problem with the tax basis. Perhaps this balance sheet discussion is going to be after the tax, because we have an adjustment to the tax depreciation for the uh, uh, for the ITC. And we'll compute IRR, assuming that all of the ITC and all of the tax depreciation and everything else can really get used. That's the IRR that will afterwards be split between the tax investor and the sponsor or developer. I don't know which, I forgot. I'm supposed to call it sponsor. Okay, so let's go back and let's again, you're probably bored with my little diagram that maybe the colors aren't very good on this really. But if this little thing says we can apply debt or not. Don't apply debt, then we get pre-tax IRR, after-tax IRR is bigger than pre-tax IRR. We can give some of it to the sponsor, some of it to the developer. In this case, if we don't consider stranded taxes, which is really why we're making this which is why I'm imposing this video on you. By the way, I put little graphs at the bottom here too. And what a silly thing to kind of suddenly think. And we can put the graphs with or without the kind of thing, and you can see what happens to the different cash flows over here. Okay, enough of that. That helped us a little bit when we were struggling with things. All right, good. Now, we're going to compute a balance sheet at this level. This difference between the amount of the return you would get if you had no stranded tax, no limitations on your taxes from reallocation of income from the sponsor back up to here, meaning the income goes up and you have to pay more taxes. That's the reallocation. That's caused by the inside capital called, I think, the 704B, if you remember these horrible little numbers, or you can have something called a suspended loss, or you can have something called an excess dividends, and there's a number for that I'll remember. Now, the reason if we put debt in the project, this time we put 51%, maybe we can put even a higher amount of debt. Okay, then, by this time the sponsor investments is going really, really low. Now, the problem with putting debt at this project level is these tax investor cash flows are suddenly a little bit subordinated to the debt. The good news about this is that this IRR is getting closer because this debt can be used to classify as capital. And if we put a little more debt, we don't have as much exposure to these things that somebody calls stranded taxes. Now, right now, the developer went down to zero, so that probably wouldn't work, okay? And we look at the sources and uses kind of how we get all this debt. Whatever. Right now, does this DRO have? This DRO has a little bit of an effect in this case. We need to study that. That will be video number 3. I'm kind of getting ahead of myself. Now, if we put debt at this level instead of this level, look what happens to this. Then, their IRR goes down a lot. Well, if they had no debt, they get a little bit higher IRR because of this preferred yield and the status of this preferred yield relative to the debt. We're going to talk about those kind of little subtle issues. And if we put less amount in there, their IRR goes up, but they still have some stranded investment. So right now we're going to look at this, and we're going to look at this thing called the after-tax levered IRR, and if I press this button, it takes me over to the regular operations page. So the place we stopped before, and this is okay if you turned off that other video, we stopped at the cash flow to the partnership, which is really very simple. It's the EBITDA, pre-leverage, pre-tax. And we put in the CapEx, and these CapEx have no ITC, nothing gets done, and then we have this, and then we have this 6.27. So basically there's an IRR kind of at the bottom of the page, and maybe I'll have a discussion later. Now, I just had a little talk today. Now if again, right now, there's a caveat. In order to explain this stuff, I used an annual model. If we had a periodic model here, we'd start, I'm putting it together, and it'll even be on the website. It'll be basically the same diagram. Everything's the same, except there'll be some construction debt for a construction loan, and there'll be a bridge loan for the tax equity, and the flip period will be a little bit, can be in the period of the year, and the taxes will be paid quarterly. So we'll just have to go through some Excel stuff to get all that right. All right, I think you can sometimes with the annual model, I'm almost convinced, maybe not quite, that this is better. So now what we're going to do first is, let's talk about how this page is structured. I put everything in column B, and that means the table of contents will take everything from column B, and I better do a little bit of a reformatting. I think I have 8 rows. Why did it leave it as 8? And then let's mark links put the color of the sheet when we mark links. And the reason I'm doing is, let's put a sum column. Oops. Maybe I should have put a border on there. Okay, well, I'm putting it in just year 0. there might be some sums in J. It found the column J, and we'll go forward. Now, when we set this page up, I'm going to hopefully kind of work through this page to, and the reason we size the debt is the next step is to make a sources and uses of funds. And in this case, like I have with so many of my other models, we put different options for sizing the debt. And then once we get to the equity, we split up the equity. Laying out the sources and uses for me is a really big deal. And we can convert this debt to back leverage later on. But remember, the back leverage, and I don't think I did that shit. If I take this off to be the front leverage and put it on the back leverage, this actual realized IRR is really hurt a lot. Can you see how it went down to 10%? Well, that was kind of extreme. And this one is affected. So the debt really affects the actually the tax equity returns. We'll see something else, that the tax equity probably doesn't like this project debt. And then we have a standard debt repayment. I don't know if you like this shorter thing or not, who cares? And we'll put different kind of sculpted or flat repayments or mortgage style repayments, all the blah, blah, blah. And then we'll go through some tax analysis, and this structuring it in this way. At first I thought, oh, let's leave debt out, kind of, let's not mess it up with debt. But we put debt in, and then we do the sources and uses, and then you go through the debt repayment, and then you go through the taxes. Now, the partnership, remember, does not actually pay taxes, but the partnership generates these ITCs and tax deduction. So we'll talk a little bit about some of the tax issues and the associated modeling. That's really kind of standard, even though it looks, you might be proud of this. And then we'll put in this balance sheet. And then we'll be kind of finished with this thing. And this balance sheet might seem like a waste to do with our little test that should then go into a audit page. And then we'll make our hypothetical, our kind of IRR with the equity IRR. We'll get an equity IRR and a project IRR for the company. And then we've got these IRRs up here. And we've got the pre-tax, we'll get the after-tax unlevered IRR. And after we compute the debt, the pre-tax levered IRR, excuse me, that's not a common one to compute, but basically ignore the taxes and take the debt out, and that's somewhere a little bit upstairs in this sheet. Okay, so let's get started. Now, perhaps the best way to do this is to work through some of the inputs. So that we've kind of sorry. I think I put these in column B. We put the capex, the operating expenses, the merchant assumptions. Then I think the right thing to do is starting to put some tax inputs. Perhaps I'm a little inconsistent here, because before, and then we're going to talk about the allocations, and I put the debt funding at the end, which is what I always believe you should do, but when you get to the sculpting, there's a little bit of a problem. So we have a little bit of a flag that says, okay, should we even put no debt in? And this is a flag. Should we put it as back leverage or project level debt? And then we can size it. Either we just use a classic little tool, 1, 2, 3, and we can size the debt from the required DSCR. Standard. That's why I put the debt sizing right at the top because we need the cash flow to get the debt size. Or we can size it from just the debt to capital, I said, as a percent of capex. Or if you want to put a fixed amount in, you can do that too. Okay, and all of these have little spinner boxes, and all of these inputs come from the, you can put these in by project. And remember what I said, which was, I think, pretty important, is that these, you could set this up as just a bunch of scenarios. All right. And then I put a very simple interest rate in without credit spreads and changing credit spreads and swap rates. You could do all the debt service reserves, which we can put in, and debt fees and everything else. That can all be entered if you want. You can get much, much more detailed. This was really built for smaller projects, but all those little details, they're just that, they're details. So now let's go to this partnership account. And here's where we start. I put the debt sizing method. So if it's one, it's this one. That's where we start. And then we say, okay, here's our cash flow. And the key thing up here is also to put a tenor. And what I just did was press Control and that square little bracket. And then I press F5, and I've said that a lot, but somebody taught me that a long, long time ago, and I think that here's the key point about this. If you can make your model so you can use that, if you press Control and square bracket, and it's got a bunch of variables here, you can't find them. When I'm reviewing somebody else's model, and I've had the torture of doing this, trust me, trust me, trust me, you want the formulas short so you can find the variables. And then when you look at a thing here, then we get this is kind of bad. I should have almost put the cash flow in separately. And I think I'm even going to do that because this was my kind of rule. EBITDA, why do I copy this like this and put, oh shoot, I didn't have, I don't have, EBITDA transferred, transferred from operations. Now, I'm giving myself a little excuse here, and we have all of our timelines exactly consistent. Okay, and in generic macros, I think I have shift up. Oh, shoot. This horrible thing with I'm sorry about that. This is the shift control R, my shift control D, remember. So that's just that. And if I'm going to do this, I'm going to pause the video while I redo the now maybe this was a waste, but at least I didn't waste your time. If you look really, really, really careful, you can see that that's a purple. Can I do this to show you that it's a purple? Oh, no, not really. Can't remember. Oops, that was too small, isn't it? Okay, that was a purple line. And then, so now it's a little bit clearer. And I think that's a pretty important rule. So now I can press the F2 key. And if I'm going to take something from another sheet, I can just trace it. And even as Pascal, I don't know if it's a bunch of crap or not, he wanted me to make this, which was a good kind of exercise. When I take something from another sheet, perhaps I should color that one. I haven't run that one in the generic macros yet. Okay, and now, so what we have then is we put our target DSCR in, and this is, I'm kind of fixing things. This is out of place, and I'm Shift Control F will remove this. And then we get our, just to be kind of a little more transparent, we get that, we take that and divide it. Remember, this only occurs over the loan life. And then we have the most crucial debt formula in project finance, the present value of the debt service is the value of the debt right at the start, at the COD, and this is an annual model, so we don't have to use some product divide by or anything else. Remember, XNPV would not work at all, please, if you have changing interest rates. And then we also, I'm going to use a LLCR method later on in case we sculpt the debt and in case we size the debt from a debt to capital, and I made a video on this even yesterday, and then we sculpt the debt, and then we get the total. So then if we use the other method, again, I take the F5, and please, I just think this is so crucial to find things. We take the different methods. This is the total capex, which is a little bit bad because you have to go down to get it. That's almost like a circular reference because that could include fees and IDCs and everything else. That's kind of in our mini version a circular reference. I have to speak quietly because it's a little bit upsetting. Okay, Shift Control G if you want to put a little double underline. So this debt we say, and then I put up here what kind of method we really took. And it would be better probably to put this down here, wouldn't it be? So in this case, we took the debt size from the DSCR. If we wanted to take the debt from the debt to capital, we take this one, or we could put a fixed level of debt in, okay? All right, I don't know if I'm convincing you. And then finally, we can say, don't even apply the debt, just zero it out. And that's just a true false. This little thing, I'm starting to use more and more. Maybe I'm getting old and senile. I couldn't remember a couple of things today. And then we can put project. If we click it off here, it goes into back leverage. So it's just going to turn everything off. Let's leave everything on for a minute. And then I compute this number, which is the total debt divided by I'm sorry, the total present value of all of the cash flows, not the debt service, and we divide it by the debt. Now, the reason I do that is if we want to have debt sculpting and keep the DSCR the same, it won't be our target DSCR. If we put a debt to capital, that doesn't work actually because our cash flow is less. So we've got too much debt in this project right now. Just a minute, I've got to kind of reduce the level of debt. All right, we can do it right here. Okay, and then our LLCR, if we were going to fix the level of debt, notice that this level of debt is higher if I use debt to capital than if I constrain it with the DSCR. Okay, that's kind of standard stuff for me, really, I hope. But maybe if you're looking at tax equity, maybe you get confused by the debt. I think the capital accounts and the tax constraints and everything else are a whole lot more confusing. Now, we put in the CapEx. If you have some transaction costs, you can add those. If you have a debt service reserve account, you can put that in. You can even have a reserve account for the inverter, and the debt fees are a pain. That causes a circular reference because if you are sizing this debt with the debt to capital, it's our standard almost circular reference. If you're sizing the debt with a debt to capital, the more, and you have fees as a part of the project cost, if you get more debt, you get more fees, but if you have more fees, you have more project cost that leads to more debt. You go around and around. Now, that's a very easy one to solve. And I went down here, instead of using any kind, this is a one you can just solve with algebra. You can just take one, multiply the debt fee by the project cost. And I think I'm going to not go through that. I think I put a little help screen even where I described some of this stuff, right? This is a little algebra you can do to get all of the debt fees. So what I'm purposely doing is I'm going through all of this stuff in detail. Now, once we have the uses of funds, the first thing is to just figure out how much our total equity financing is. That's no problem. And then with the equity financing, we're going to have to figure out how much is this is the total equity financing again. I forgot why I did it twice. I think I should probably delete that, but I'm terrified to right now. Yeah. Let's press Alt MD, and it does go somewhere. That's too bad. That's really too bad. I'm going to have to fix that one later. I don't think we need this section because what we want to do is take the total equity financing, this number, and we want to split it to these. You know what I'm going to do? Oh, we might have a grant and things like that. So I'm going to press Shift, Alternate, and forward or right arrow and kind of cheat and temporarily hide these. Okay? And then we have the tax equity. Now, to get the tax equity down here, we first start with the investment tax credit, and then we put this thing called a contribution ratio, and I'm fixing this as I go across. I don't even save the file because it shows how much more than the ITC does the tax equity put in. And if this is a pretty low number, pretend this was 1. The tax equity would put in no investment. Do you understand that? They put it in, they get it out. 0 investment. If it's 31%, they put in their investment is 31% more than their ITC. So for 31%, they get basically 99% of the tax deductions if there are no constraints of the tax depreciation. Plus, they get this preferred yield sometimes, depending on how you structure it. And plus, they get some operating cash flow. So they do pretty well for 31%. And the reason they need to get some operating cash flow, they have to demonstrate so it's not kind of just a fraud transaction that they're actually they're actually putting some money, they're taking some risk in the project. And there are debt fees, so we've done this. And then finally, so that's all that. And then we have the debt up here, I suppose. Where's our debt? Come on, it's down here. This is the key thing right here. This is the uses, sources and uses. Okay, laying out the sources and uses is such a crucial step. And then we put we take that debt and we repay it, and we can repay it either. It has nothing to do with the sizing. We can pay it with mortgage debt, sculpted debt, or flat debt. Now let's talk mortgage debt first. That's pretty easy. I think you use a PMT, not PPMT right now. And you just take the amount of the debt. So I put the amount of the debt here from upstairs, the lifetime of the debt, and the interest rate, and we get the payment. That gives us the total debt service. It does not give us the interest. But then we go down to our debt balance, and we know our repayment is our total debt service minus the interest. And that way, so we can just fill it in. And then I had to make a little switch there, that little 84. And this is almost what I don't like to do. You could almost say, why didn't you put that debt flag somewhere up here so we could see it? So when we press the F2 key, we can see it. That's what I call transparent. My new definition. I'm getting old and forgetting things, but transparent means you can see things, right? You can see right through you. And F2, with the F2 key, you should be able to see everything. And I can see almost everything. And then if this is sculpted debt service, here we use the LLCR, not the DSCR. Now, if we would happen to have sized the debt from the DSCR, that's this one, and you will be able to, I'm not going to give you this file until I've finished the all of the changes, because I'm going to make changes as I go along while I'm trying to explain things. This is this is simply the this is simply the DSCR. That's the target DSCR we put in. Now, if you would size the debt from the CapEx, well, then we need to repay the debt, and we need to use since we had more debt, we have to use a lower DSCR. That's not really good enough to, and then the debt, the DSCR stays the same all the way through. And I didn't even put a big output for the DSCR because I'm totally focused on the IRRs, but then the debt gets repaid. Using this little LLCR trick allows you to repay the debt. And you can say, life is much more complicated because of circular reference, blah, blah, blah. Well, a little bit, you're right. Changes in debt, interest rate, you're right, but not that bad. Really, really not that bad. Okay, I think what happens is some people get so obsessed with some of the tax equity, including me, you forget kind of some of the fundamentals of the debt. And then it is possible, unfortunately, that your debt might have a default. Now, this doesn't, okay? And if you don't have enough cash flow in the partnership to pay this debt service, you're going to have a default. And the tax equity is really going to be pissed off about that. Because that tax equity, despite what all the rules says, those guys just want their cash flows back. They want some preferred yield, and the preferred yield will probably be subordinated to the debt. Maybe you could negotiate it with the banks and switch it around. Maybe there's a tax problem with that. And then I put some other debt service reserves here in here. But then once we've got that, we can compute without taxes, and that's the one I was kind of looking for, the equity. I'll put equity IRR at partnership level without tax. Okay? So this, again, this goes into our wonderful little diagram, which I seem to have lost. And that's this one. So in this case, we have our unlevered IRR was 6. Because we had a short term, if I would make, whoops, what happened? Maybe that little, what I do is I right click on this and put a little link here. Maybe that's what made it go kind of slowly, but whatever. If I put a longer tenor, if you could get a longer tenor, you can see that the IRR is starting to go up. This is just very standard gearing. But as long as this is greater than this will have a positive effect. It doesn't have as much as you might think. Well, that's because we only have 43% debt. You know, if we size it, if we size it from the DSCR, then we get a little bit more. And if we could even make it longer, then we can start to get it. And then when we look at the after tax, look at this after levered, then it really gets crazy. Okay, so that's our gearing, and that's how we can look at it. And I hope you're saying, oh yeah, this is right, I like these little diagrams, I like visualizing things. My friend Mario from Australia, he's wonderful. We have these wonderful philosophical discussions, and he took a course in visualization, he said. All right, and I'm pissed that I have the color's a little bit not right. I have to get more artistic, or somebody has to help me. Please, somebody help me on this. Okay, and then now we're going to go through the tax analysis. And the first business is you just take the capex, and then you need to maybe ask a accountant a little bit, but they don't give you good answers anyway. I'm assuming the fees are part of the project cost and they qualify for very advantageous tax treatment. Now, there are going to be some expenditures for things like transmission that don't qualify, and you're going to have to put those in. And those just, of course, then come, I said, of course, they come from the project database, control square bracket again, and then you can press the F5 to get back to where you were, and the F5 again. Oops, nope, that F5 only works once. Sorry. Okay, and then so this is when we're finished, we take away our non-qualifying, which could even be the fees. Okay. All right. Remember, don't change this. Change this only in the database. Don't change it when you're not supposed to. Okay, and then this one, did we leave a 30% ITC rate in here because these other ones are less. And some people, I think if they, you know what these people did? They ordered a bunch of panels or equipment and stuff, or especially wind, that was with a production tax credit. So they officially get that treated as under the old tax laws. Very, whatever. Okay, and then we put in our depreciation rate. Now this again is simple. It's a lookup function. If you're using the lookup function and you want to audit, you should be able to look at this last one. And I, again, when I see people using the lookup, I say good, but they almost always don't use the whole thing. Instead of pressing control and square bracket, we just have to look for in the inputs number 140. Now, when you do this MACRS, it might be if you put it in kind of at the end of the year, you then get this half year business, and even if you put it in the beginning of the year, you can get a full year, and the half year I just put as an input. For this one, you can put this thing called VDB. Perhaps I won't go through it. It's variable declining balance, and the only trick to doing that is you have to put a little time series and put a little zero to get it started. So put equal VDB. I promise not to do it. And it says put the cost. Let's put 1 in for the cost. Put 0 in for the salvage. For the life, put 5 years. Press F4. And then put the start period. That's the 0 I was talking about. And then the end period. And then if this is this, I still call it MACR, modified ACRS. See, people don't know what that is because they weren't alive in 1982 when ACRS, called Accelerated Cost Recovery System, was established. And then I think in 88 or something, they changed it to Modified Accelerated Recovery System because they'd given too much away, I think, the first time. So that's enough of that. And then you can put a 15-year occasionally, so the assets that aren't qualifying might have 15-year or 20, so that we need all of these tax rates. Okay, and I wonder if you're getting totally bored by this or that. And then we put in our tax basis, and where does this number come from? This is 1 minus, just a minute. That was a bad one. 87. Sorry about that. No. Okay. This is just this one. I'll press Alt D. No. Alt MD. And it is used. Times that one. So this is just a minute. H127. Oh, sorry about this. Age 127. So, this, of course. How stupid am I? Oh, God. And then I don't know how we remove the arrows. Okay, other than that. What? This is if you take an ITC, so we better put the ITC up here first. And really, this is 1 minus half of the ITC rate. We almost should have done this calculation here. That would have been more clear. I mean, I should have known that. Sorry. Okay, that's what it is. And then that's our basis. And I put that as a different amount. Now, if you have state taxes to make things crazy, you could certainly argue that the federal government, you get the ITC reduction on your federal taxes. You don't get to get the ITC reduction on your state taxes. And you could say, no, 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 I got a higher tax basis for my state taxes. Now, I understand from tax accountants that different states do this differently, which makes it really, really painful. I go crazy with the state taxes, and to say that you can only use federal taxes is not correct at all. If you have a project in New York or something, and they have a state tax rate in New York, and then all of this business of accelerated depreciation and everything else, that applies on the state taxes as well as the federal taxes, especially the lifetime of the projects. That's what I understand. It's not a whole different depreciation, but the ITC is the only issue. Understand in California, in New York, you would depreciate this amount. California, you would get the additional amount. That's what I understand. And then we put our basis reduction, which is this 50%, which that comes from the thing. And then we just say that's times the investment tax credit gives us this. Okay. And then we multiply the tax rate, the depreciation rate, by the tax basis, and we get our tax depreciation. And we can do the same thing with a different basis if we want. And that's our additional depreciation for state taxes if we have some. And this is again, a lookup. We would look to 145 in the input sheets. Please. I didn't understand the importance of keeping things transparent. FAST. I'm obsessed with T today because I've been having this nightmare project when I didn't get to make any videos because I was just looking for things that were impossible to find and understand. You have to put yourself in other people's shoes, to put yourself in the shoes of somebody trying to understand this. There is nothing worse. Even a tiny little bit of a long formula will drive you completely crazy. I was trying to make new videos just to demonstrate this, and I can't really. Some nice person from Korea told me, no, make a video on reviewing other people's models. Don't you have a very special method to do that? I'm thinking about that. Okay, so we have all of the taxes, and we can have a separate thing for tax rates, which is a pain. And really, we could stop here, and actually, I think we should. I'm going to make another change, and I'm going to do it this way. So all of this hypothetical return for the adjusted taxes. Now, I just learned something. Control X. And when I press Control X and I want to plop it here, if I press Shift Control Plus, it'll insert it for me. Maybe you knew that already. Okay. And then we can put in our balance sheet, and oh no, okay, and we have a difference of, at least it's a flat difference of 10,000. Okay, we're going to I'm going to talk about the balance sheet, but of course I have this saying that there is no better feeling in the world than the balance sheet balances, blah, 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 and I better stop it to see. Okay, now, all I had done is when I changed this, not all I had done, I had had some transaction fees, and it was easy to find the 10,000. And those transaction fees were not included in the uh, the basis for the depreciation and the fees right here. So I had to add them. Okay. Good. Oh, whatever. I don't know, if it's your own model, it's a lot easier to find this stuff than if it's somebody else's model. And I don't know if I'm not necessarily, I'm afraid to say, Jeff is able to use this model for a lot of different things, but you've got to be careful, I think. Okay, it's better you structure this. But this is all pre going through all the capital accounts. Okay, so then we take our federal tax rate, and we can get our operating taxes. Notice that, and I call these operating taxes, notice that they're negative, and of course the tax investor wants these negative taxes. That's what they want. And they definitely want the ITC in year zero, so that the total taxes paid are negative, 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 and then they go to be positive. Okay, you can't get rid of them forever. And, I realized that this is only 35 years. Well, this is too long. 35 years for solar. Did I put 35 years for solar? That's kind of stupid. Let's make Vladimir. He's got 30 years. This is 25 years. Okay, so we got some taxes out here. Interesting. Okay, and then we could put some state taxes in, and we could use the same taxable income, and we just add the federal and state tax rate. And I tried to put some different. All I'm going to say here is the easiest way I would think, and I was told to put the state taxes in, is probably just, instead of doing, oops, I shouldn't have done that. That was very, very bad. That should have came from the other one. But really, if you're doing this modeling, and it's probably by far best to just add these together. That's what I was told, because Jeff was very nice. He paid this money to a tax accountant, probably paid for 1 hour of their time, more than 100 hours of my time, but whatever. And then I'm going to just zero out the taxes. I'm kind of afraid to do that, but I'm just going to, oh yes, we put a zero here, and we have an option. I'm just going to put a zero tax rate, state tax rate, and we'll put it here. Okay, this is not very good, but it's not that bad either. And then we get, now we take our EBITDA less capex and all that stuff that we had from our other one. Notice that that's even a little bit of a purple line. And then we take away, which is adding, the federal taxes. And right now, for this case, we get a 5.97, and on this one, we'd had a 2.53. With 5.97 IRR, if you get a pretty low interest rate, you can start doing some good stuff with that. You can even argue that 5.97 as a rate of return isn't that bad. Okay, especially if you think that solar is all very safe. The problem here is, of course, if you're a really big company and just throwing this all in your balance sheet and you have enough ITC to cover yourself, you can almost really stop here. Okay, but we didn't put any debt here, so we could also put in the debt, the interest expense, and then we get a tax shield from our interest expense, And after gearing, this is really the equity IRR that you would get, excuse me, after the debt. And I hope I didn't do that too quickly, but basically we take our cash flow before financing that we took anyway, we take away our we don't take away it. Yes, we take away our interest, but add back the tax shield on the interest. And then we add back any debt you get. That's a positive, okay? Okay, good. Oh, that's great. If I can move that date. And then we're finished. Okay, and then we blah 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 blah. We have less, of course, investment. I say of course, but I don't know. I made an error there. And then positive. And again, now what should happen? I suppose we could even put a zero tax rate, but that's not silly. If I press no to the apply the debt, these two IRRs should equal these two IRRs. And I hope you can see how we've checked everything. And then we'll go to the partnership account. Okay, and in our partnership. Now, when I have my class on this one, I have a feeling that if you're still watching this, you're amazing. I forgot what I was going to do. If you're still watching this, I was going to put your name on a website somewhere or something like that after you send me an email. Yes, but here's the balance sheet, okay? And the reason for this balance sheet is eventually, not eventually, but pretty quickly, we're going to go to the tax equity accounts. We'll have to clean that up, and the sponsor accounts. And on the tax equity accounts, let's go over to column B, and we'll compute this thing called the outside capital. And the outside capital has a bunch of things that look all complicated, and it took me a long time to get. Oh no, I gotta press Shift Control E, get out of these bad habits. Maybe we should come up with a way to automatically put the underlines in somehow. Okay, I don't know how. And then, so we get it's like an equity balance. And then somebody said, I almost should put this in audit, perhaps. We have back leverage, sponsor inside capital. Here's a reconciliation. We'll have the total equity balance from the partnership balance account. Notice that this comes straight from K230. This comes straight from this one. There's K230 minus the basis adjustment that we'll talk about, okay? And then we can compare and make sure that when we take this one and we have a balance sheet for a tax investor, a capital account for the tax investor, and the other one, they sum up to the same amount. It's like a big test. And then we have true, and then, I have a false over here that I'll have to deal with eventually. This looks like something when we're selling the asset. We're going to have to make sure of that. I did that on purpose. Not. Okay, but that's to get this started. At first, I thought, why bother with a partnership balance sheet? Who really cares? We don't have anything to check. It's all very simple. And then we put our plant balance together. This plant balance better be kind of from all, that includes all the fees and everything else. So what I should do is put plant balance including fees, okay? And then we put our accumulated tax depreciation, and don't ever, ever assume that, and here's our little thing that's different. Oh, this is the, okay, whew, this is the thing that drives me crazy and maybe we'll fix. The accumulated don't ever assume that if you've got book purposes or the tax law says take book depreciation, they always mean at the tax depreciation rate. It's never straight line depreciation. Don't get confused when they say inside capital is the a book basis kind of thing, and you say, oh, maybe I should take straight line depreciation. No, you don't. Those are the kind of questions I always had. And then here is indeed the problem. This thing up here, when we put in where did we put it in? This was, I just found it, I think. This was our 50% of our tax basis. Well, you're never going to depreciate that. That's never going to be depreciated. So when you compute these capital accounts, this basis difference, okay, right now, if we go through, oh, I didn't appreciate the fees. Okay, sorry about that. Just a minute, I gotta fix something. I'm gonna pause it again. This is why I'm doing the video. I'm trying to do two things at once. Okay, I got all messed up because I thought I was wrong, but I wasn't. The difference between the accumulated depreciation and the total asset value is this 50% write-up. This includes the total assets, and this includes, I put less the ITC tax basis adjustment. I'll put ITC 50% tax basis adjustment, just so we remember. And you can, for the kind of for accounting purposes, you never get to depreciate this. So it's like a less. It's like you're taking this depreciation right when you take the ITC. You never get to do it. So that part of the assets just gets depreciated, and it's accumulated for the whole time. So the net plant, I was all wrong. The net plant does go to zero. Now I was all worried about, and I have to change this back, the inverter cost. Oops. And I put a little multiply by zero there. Okay, and when we have the inverter cost in there, let me just make sure it does, and then I'll cry if it doesn't. So our net plant goes to zero, and then we put our inverter and we capitalize our inverter, and then it goes back to zero. So we're double checking that everything's okay. And then we could put a debt service reserve account or an inverter replacement, these reserve accounts in, and that's basically you put some cash and then you use it when you spend the money and all of that, but we don't have any of that. So that's our net assets. And then our equity balance, well, that's everybody's equity. So this paid in capital, I hope that's from the balance sheet. And I mean the sources and uses statement. And I look at this, I zeroed out the debt. And when I do that zeroing out the debt, I put these little switches so we can just put them back anywhere. Some of this stuff, I know people probably are saying, nah, that's bad Excel form. But for me, if you can just switch all those true false on and off and then see what happens, that's not so bad, is it? And then, so this is the amount of capital we paid in, capital we actually put in, and then here's the debt we have up here. This is the debt, and the debt gets repaid as usual, blah, blah, blah. And we add the income, which is from our tax statement. So we can go up here, control thing, and control square bracket to find our income, which is just the EBITDA minus the interest. And I hope this is doing, which is I'm not doing very well, but introducing you to an equity account. This equity account, or whether we include the debt or not, is another really big issue. This is kind of, we're going to put that same sort of account in. We'll call it the net assets, really, or the net capital. That includes equity and debt capital, because you get to share the liabilities. You get to put that in your capital account. That's why the IRR is affected by the project debt. I did that way too quickly. That was a bad thing. And then we get everything, and the ITC adjustment, basically I have to take away from the capital. It's like a loss. It's like a reduction in capital. It's like taking depreciation in 1 year. That confused the heck out of me at first. It still does. I shouldn't have said it first. So just think of this, but maybe by making a video, I'm helping myself more than you. This 50% tax basis adjustment was completely driving me crazy. We take it out of the assets, and then when we're going to reconcile it, we call it basically like a one-time depreciation to reduce the asset basis. So our accumulated depreciation will, if we include this kind of in accumulated depreciation, it'll all work out. And then our balance sheet balances. Okay, and the debt, as always, this debt just comes from upstairs. And then, so now we have kind of our video number 2. And again, all we're going to do is take all this income and start allocating the income, allocating the cash flow. We might have an option to sell the asset. And then we got to work through all these balance sheets accounts. And they get painful. They get painful. And that's why I reserved 2 separate videos to work through the tax equity, and then the final video to work through the sponsor equity. All right, and that's enough of this video for today.